Today's sell-off comes as the market bumps up against some key levels. So where are we headed from here? Let's go off the charts with Rob Sluymer at Fundstrat. Rob, what are you looking at?
Hey, thanks, Melissa. So there's obviously some pretty key levels here. Bob mentioned them earlier, that 22.32 level at the June highs. That's obviously be the sort of first support level. Takes us right back to the June 8th highs. The next level I think we should be looking at is at that 31, roughly 3,100, roughly around the July lows. And then I think everybody's focused on that 200-day moving average, which is around that 3,100 level. And then that's followed around about 3,000, which take us down, to the July lows. So there's a pretty big band of support here that I think the market can pull back into. A lot of the shorter-term indicators, which you can see on the chart, in the bottom panel of the chart on the screen, is working its way down into oversold territory. And we certainly see that with a lot of technology stocks that led the correction. I think it's interesting, though, that when you step back and you look at the intermediate term background, when you're looking at weekly charts, a lot of those still need a lot more time to unwind before they get back to sort of a neutral or even an oversold level. So we're expecting a bit of a zigzag pattern. You come down into these support levels, you get a bit of a bounce going into the beginning of October, and then another pullback going into the middle of October. And at that point, I think a lot of stocks will have unwound a lot of that excess that developed going into the end of the summer.
So we're looking at another couple of weeks, basically, Rob, until you think that there could be buying opportunities because it's unwound enough.
That's my roadmap that we have going into the middle of next month. Obviously, we're going to get some short-term bounces in here. I think we're probably setting up for one relatively soon. But I think in terms of really putting capital to work, it's just an issue of time. The market still needs to unwind a lot of the excesses here.
You were talking a lot about Apple, Rob, and I'm wondering what your thoughts are on Apple and whether that is one that has unwound enough or if there is more downside here.
I don't think it's quite there. When you look, again, if you step back away from the noise of the daily charts and we look at the weekly chart profiles, it still needs quite a bit of time. So I think there's still more downside in Apple. But there's other names out there that are starting to come into some fairly interesting levels from my perspective.
Yeah, which are?
Well, let's start with some of the big cap growth names that have broken out of 2-year trading ranges. Amazon would be one, but Netflix, for example. I mean, I think these charts, as much as people are talking about a secular peak in technology, Netflix is just pulling back. It's getting to those levels where it's getting back to the top of that trading range around that 425 level. So again, a little bit more time, but it's going to catch up to the 200-day moving average, the 40-week, and to the upper end of that trading range that's been in place for the last 18 months. And when you look at something like an eBay, for example, same type of profile, but not that extended. They're unwinding that excess, sort of in that 42 to 44 range. I think it gets really interesting. And then probably one that has a lot more hair on it and is probably controversial, but I think the semi-cap equipment names are so important because they led the correction. They peaked on August 8th, well ahead of the market. And something like Lam Research is already back to its 200-day and it's been chopping around that level for the last week and a half. So I think that's actually fairly interesting at current levels.
All right, Rob, great to speak with you. Thanks for the charts. Rob Sluymer of Fundstrat. What do you think of these names, Tim?
Well, if you think about some of the tech names and you think about Lam or you even think about eBay, I think you have some of the secular trends that have made some of them to be go-to stocks, but Netflix for sure. And what I think we've seen, and I think we saw this earlier this week when we walked in, some of that news on Monday was around Europe and some of the uptick in COVID that we were hearing and some of the closures. What were the trades that were very defensive? And Netflix was certainly one of them. So I think you can follow some of the same playbook because there will be those folks looking back into the stay-at-home trade. I think largely, if you look at the NASDAQ 100, as I have indicated, I think we go back to around those July 1 levels that I think are some of the places that Rob was talking about. But on the triple Qs, that's somewhere around 240 to 245, which would make it a 25% pullback.
2850 didn't cross Rob Slimer's lips, Steve Grasso, so I'm curious what you think of his levels.
Yeah, no, I like Rob's work, and Rob is being, realistic in what's in front of him. And obviously those levels of 3105 in the S&P and then 3,000, the natural big fat round numbers attract people. But I'm looking in worst case scenario for what we have to test. And I do believe that 2850 level will be tested yet again. And as far as his picks, eBay and Netflix are both up 40 and 45% year to date. I would go with the Lamb because it's counter to everything that people hate about the marketplace. Tech is overbought. It's bloated. Lamb, as he said, first to peak. Now it's troughing. I think it's time to buy that one versus the other two.